All right, let's do this. Today, we're going to dive deep into the world of stock exchanges.
Ooh, exciting.
Yeah, I think it will. We've got Chapter 6 of Personal Finance and Investments by Keith Redhead.
Excellent choice.
Yeah, and I have a feeling this is going to be way more interesting than just your average finance textbook.
Oh, absolutely.
Yeah, so we're going beyond just, what a stock exchange is.
Right.
We're going to try to figure out, why should you care about this?
Yeah.
Why does this matter to you? Even if you've never even bought a stock.
Exactly. And that's the thing,
Yeah.
Stock exchanges, they're not just these abstract financial entities. They really are the heart of our global economy.
They are. Their impact ripples out into everything. I mean, every aspect of our lives.
Think about it, all the companies that drive, innovation, create jobs, shape our future.
Right?
Most of them rely on stock exchanges to
Yeah.
fuel their growth.
Okay, so I'm intrigued, but let's back up for a second.
Sure.
What exactly is a stock exchange?
So you can picture it kind of like a giant marketplace where companies and investors meet.
Okay.
And so companies that need capital to grow, expand, maybe develop a new product,
Right.
they can issue shares of ownership in their company.
Okay.
And then investors who are, looking to grow their wealth can buy those shares.
So it's like a matchmaker
Yes.
for money.
A matchmaker for money.
But without stock exchanges, how would these connections even happen?
Right. Well, I mean, imagine a world where companies had to just individually
Oh my gosh.
seek out investors every time they needed funding.
That'd be a nightmare.
It'd be chaos.
Yeah.
Incredibly inefficient. So stock exchanges really streamline this whole process,
Right.
bring some order to that chaos.
Okay, that makes sense.
Yeah.
So, I mean, why wouldn't companies just borrow money from a bank? Why go through this whole process of listing on a stock exchange?
That's a great question. I mean, bank loans, they have their place.
Yeah.
But for companies that are looking for significant capital, going public, going through the stock exchange offers a whole different scale of possibilities. You're talking, access to a much larger pool of investors.
Yeah.
Potentially raising, billions of dollars.
So it's like leveling up, right?
It is. It is. Going from that lemonade stand to a global beverage empire.
I like that. That's a good analogy.
I like.
But there's got to be some downsides to this whole going public thing.
Oh, of course.
Right.
I mean, listing on a stock exchange comes with a lot more scrutiny,
Yeah.
regulations. Companies, they have to disclose a lot of financial information.
Oh, yeah, that's right.
Which some might view as airing their dirty laundry in public.
Right.
Not all companies want to do that.
Right. It's like that double-edged sword of transparency.
Exactly.
Right. It can build trust with investors, but also means you can't hide anything.
Right. But that transparency is actually a key part of what makes stock exchanges work.
Right.
It allows investors to make informed decisions.
Right.
And it helps create a fairer, more efficient market.
Okay, so I see how all this is fitting together.
Mm-hmm.
We've got companies looking for capital.
Yes.
Investors looking for opportunities.
Yeah.
And they come together in this big marketplace called the stock exchange.
That's it.
But how does the actual buying and selling happen? How do you determine the price of a share?
So that's where we bring in the concepts of the primary market and the secondary market.
You mentioned those before. Can you remind me what the difference is again?
Yeah, so think of it this way. The primary market is where companies first issue their shares,
Okay.
like an IPO,
Right, an initial public offering?
initial public offering, yep. That's where the company gets the money directly from those investors.
Okay, so that's like their first big fundraising event.
It is, it is.
Okay, but what happens after the IPO? Where do those shares go?
So that's where the secondary market comes in.
Okay.
So this is where investors trade those previously issued shares among themselves.
Okay.
So think of it like a bustling stock market floor.
Right.
Except today, most of those transactions happen electronically.
Oh, yeah, of course. So the secondary market is all about the investor-to-investor trading. The company's not involved anymore.
That's exactly it.
Okay. But, I mean, is a healthy secondary market important, even for companies that have already gone public?
Absolutely. A healthy secondary market is crucial, even for companies that have already done their IPO.
Okay. I'm curious, how does that work? Why?
Well, imagine you are an investor.
Okay.
You're considering buying shares in a company's IPO.
Right.
Wouldn't you be more likely to invest if you knew you could easily sell those shares later if you needed to?
Oh, absolutely.
Right.
You don't want to feel stuck
Nobody wants to feel stuck.
with an investment you can't get rid of.
Exactly. And so that's what we're talking about when we say liquidity.
Okay.
The ease with which you can buy or sell an asset without really affecting its price.
Right.
And so a vibrant secondary market makes those shares more liquid.
Okay.
And that makes investing in the primary market more attractive.
Ah, I see. So it all kind of works together.
It does. And, it goes beyond just the stock market itself.
Okay.
The efficiency of these markets influences a company's cost of capital,
Okay.
which can affect things like job creation to innovation.
So this is a big deal.
It's a really big deal.
Okay. Yeah. So we've got these two markets, primary and secondary,
Yes.
working together to facilitate this flow of money between companies and investors.
Exactly.
But aren't there different types of stock exchanges?
There are.
It can't all just be one big global thing, right?
No, you're absolutely right.
Yeah.
There are various types of exchanges, each with their own kind of distinct personality and focus.
Okay.
So you have your national exchanges,
Okay.
like the New York Stock Exchange, the London Stock Exchange.
Right.
Think of those as the bustling metropolises of finance.
Right, the big guys.
Yeah, where the biggest, most established companies tend to list.
Okay, so if a company wants to be in the big leagues, you got to be on a national exchange.
That's it.
What about all those companies that aren't quite ready for the spotlight?
So that's where regional exchanges come in.
Okay.
So they provide a platform for smaller companies to access capital, to grow,
Okay.
even if they don't meet those stricter listing requirements of those major exchanges.
So it's like a stepping stone.
Like a stepping stone.
Okay, cool. And then you mentioned, I think before, over-the-counter markets?
Yes. Over-the-counter or OTC markets.
Yeah, what is it?
Think of those as kind of like the independent boutiques of the stock market.
Okay.
They're a little less formalized.
Okay.
You have a wider range of companies and securities on those exchanges,
Okay.
often with less stringent regulatory requirements.
Oh, interesting. Okay, so the stock market is like a very diverse place.
It is.
It's got all these different exchanges and different types of companies and investors.
Good
But
to go.
with all these players, how does the trading actually work? What determines the price of a share?
Great question. That takes us to the world of trading systems.
Okay.
There are two main types, order-driven and quote-driven.
Okay, so let's unravel this mystery. Let's start with order-driven. How do those work?
All right, so in an order-driven system, think of it like an auction.
Okay.
So buyers and sellers submit orders specifying the price they're willing to pay or accept for a stock.
Right.
And the exchange acts as a matchmaker,
Oh.
pairing up those buy and sell orders.
Okay.
And that helps determine the market price.
Oh, so it's like a constant dance
It is.
between supply and
Yeah,
demand.
supply and demand,
The price is just fluctuating constantly.
constantly fluctuating.
Yeah, based on what everyone wants to do.
Reflecting kind of the collective wisdom or sometimes folly
Yeah.
of the crowd.
Of the crowd. Okay, so that's order-driven.
Yes.
What about quote-driven?
Okay, so quote-driven systems are a little bit different.
Okay.
In this case, we have what are called market makers.
Okay.
These are usually big financial institutions,
Okay.
and they act as intermediaries between buyers and sellers.
Got it.
So they're quoting prices at which they're willing to buy and sell a particular stock.
Right.
And that ensures there's always a ready buyer and a ready seller.
So it's like having a dedicated shopkeeper
It is. It is like a dedicated shopkeeper.
for every stock.
You got it.
Wow. It's amazing how much goes on behind something as seemingly simple as like buying and selling a share.
Oh, absolutely. And we haven't even touched on like the different types of orders investors can use,
Oh, God.
the strategies,
Right.
or even the psychology that
Yeah.
comes into play.
It really makes you realize how much goes into it.
It really does.
It's like we're peeking behind the curtain and we're seeing all these little gears turning and all this complex machinery
You got it.
that makes it all work.
Absolutely. Welcome back to our deep dive into stock exchanges.
All right.
Before we move on, I do want to I want to emphasize the importance of this secondary market.
Okay.
It's not just a playground for day traders.
Yeah.
It really plays a critical role in supporting economic growth.
That's an interesting point. Yeah. I can see how a healthy secondary market where you can easily buy and sell shares
Right.
would make investors more comfortable putting money into companies in the first place.
Exactly. When investors know they can easily exit an investment, they're more likely to invest.
Right.
And this fuels growth for companies,
Mhm.
which leads to innovation, job creation, overall economic expansion.
Right. It's like this virtuous cycle.
It is.
Okay, that makes sense. So let's zoom in a little bit.
Okay.
We've been talking about these big marketplaces, but how do investors actually participate?
Yeah, so that's where the world of trading orders comes into play.
Okay.
It's like having a set of tools
Okay.
that allows you to kind of interact with the market in a precise and strategic way.
I like that. So what kind of tools are we talking about?
So we have, well, we touched on market orders earlier.
Right.
It's like saying, get me in or get me out
Right.
at the best available price
Right now.
right
Wow.
now. It's the quickest way to execute a trade, but you don't have as much control over the price.
Right. So if you need to act fast, a market order.
Market order is your friend.
What if you want more control over the price?
That's where a limit order comes in.
Okay.
It's like setting a price ceiling when you're buying or a price floor when you're selling.
Okay.
You're basically telling the market, I'll buy at this price or lower, or I'll sell at this price or higher.
Okay. So more control with a limit order, but maybe it won't happen
Maybe it won't happen.
if the price doesn't move the way you want it to.
Right. So there's a trade-off between speed and precision.
Yeah. Okay. I see that.
Mhm.
What about stop orders?
Ah, yes, stop orders.
Those safety nets.
Safety nets designed to limit potential losses or, lock in some profits.
Okay. Remind me how those work.
Okay, so imagine you buy a stock at, let's say, $50.
Right.
It goes up to $75. You're feeling pretty good.
Whoa.
But you want to protect your gains in case things turn around.
Right. Of course.
So you could set a stop loss order, let's say at $70.
Okay.
If the price drops to $70, your order automatically becomes a market order to sell. Oh, okay.
To try to prevent further losses.
Oh, so it's like insurance.
It's like an insurance policy.
Yeah, against the market dropping.
Exactly. And you can do a similar thing when you're buying too.
Oh, really?
Okay. Let's say you're watching a stock. It's been kind of flat,
Okay.
but you think it's about to take off.
All right.
So you set a buy stop order above the current price.
All right.
And if it starts to rally, you're automatically in.
Oh, I see. You're already there.
You're already there.
Okay, so stop orders are for managing risk.
Risk management and maximizing potential gains.
Right. But the market, it's unpredictable.
Oh, it is volatile and unpredictable.
So what are some strategies that investors can use to deal with that uncertainty?
One of the most fundamental is diversification.
Oh, yeah, I've heard that one. But what does it actually mean?
It means not putting all your eggs in one basket.
Okay.
Spread your investments across different things like stocks, bonds, real estate, maybe a little gold, commodities.
Right, so don't put everything into tech stocks. Exactly. Even within stocks, diversify across different sectors, industries, different geographic regions.
Okay.
That way, if one area takes a hit, it doesn't wipe out your whole portfolio.
Because of a balanced diet.
And a balanced diet for your investments, you got it.
Okay. And diversification isn't just about spreading out the types of investments.
Right. It's also about spreading your risk over time
Okay, what do you mean?
instead of trying to time the market,
Right.
which is incredibly difficult,
Yeah.
even for professionals.
Yeah.
Invest consistently over time, no matter what the market's doing.
So just like a regular savings plan.
You got it. It's an approach called dollar cost averaging.
Dollar cost averaging.
You're basically buying more shares when the price is low and fewer when it's high.
Okay.
And that can smooth out your returns over the long term.
Okay, so diversification, dollar cost averaging, these are ways to manage risk.
Key strategies for managing risk.
What other advice would you give to someone just starting out?
One of the most important things is to define your financial goals. Okay.
What are you saving for? Retirement, a house,
Yeah.
your kids' education.
Right.
You got to know your destination so you can map out your route.
It's like you're saying if you don't know where you're going, you're just going to end up somewhere random.
Exactly. Exactly. And once you know your goals, think about your risk tolerance.
Okay, yeah, that's a big one.
How much volatility can you handle?
Yeah,
Are you okay with the ups and downs, or do you want something smoother?
right. Some people love that roller coaster.
Some people love it.
And other people, not so much.
Not so much.
Okay. So it's all about finding what's right for you and your situation.
Your personality, your financial situation, and there's no shame in getting help.
Right.
Talk to a financial advisor.
Yeah.
They can help you put together a plan that works for you.
Yeah. It seems like this is really important.
It is. It is.
So we've covered types of orders,
Yep.
diversification, dollar cost averaging,
Uh-huh.
figuring out your goals and your risk tolerance.
Yeah. I mean, it's a lot. It takes, knowledge and strategy to navigate the stock market.
It takes discipline too.
Yeah. And hopefully, if you do it right,
Right.
it can lead to financial independence.
Absolutely a more secure future.
Yeah. And it all starts with just taking that first step.
That first step.
All right. So we've got all that down. But before we wrap up, there's one more thing we got to talk about.
Oh, yes.
Different types of shares.
We've got to talk about those.
Okay. So we've been talking a lot about ordinary shares. Those little pieces of ownership that give you a stake in a company.
Right.
But you mentioned before another kind of share preference shares.
Yes.
What are those all about?
Preference shares, those are an interesting one.
Yeah.
They're kind of like a bridge between stocks and bonds.
Okay.
They have this unique blend of features that appeal to certain types of investors.
Okay, so what makes them so different from ordinary shares?
So one of the biggest things is the dividend structure.
Okay.
With preference shares, you typically get a fixed dividend, kind of like the interest payments from a bond.
Right.
So this can be really attractive to investors that are looking for that predictable income stream.
Okay, yeah. If you want some steady cash flow,
Exactly.
you might want to go with preference shares instead of ordinary shares.
Yeah, with ordinary shares, those dividends can go up and down, or they might not even pay them at all.
Yeah. Who knows?
Right.
Yeah, it's a gamble.
So it's like choosing between like a fixed rate mortgage versus a variable rate.
That's a great analogy.
Right. Each one has its own pros and cons depending on, what you need.
Absolutely.
Okay. But you said preference shares are kind of a hybrid
Right.
between stocks and bonds.
Yes.
What are some of the other bond-like things about them?
Well, unlike common stockholders, preference shareholders don't usually have voting rights.
Oh, okay.
So they're giving up a little control
Oh, okay.
in exchange for more predictability
Right.
and, in many cases, a higher claim on assets.
Wait, higher claim on assets. What do you mean by that?
So if a company goes bankrupt.
And they have to sell off all their stuff to pay back debts.
Right.
Preference shareholders are higher in the pecking order than common shareholders.
Okay.
They get paid back before common stockholders.
Right.
Typically after bondholders, though.
Okay, so it's like priority boarding for the financial lifeboat.
That's a great way to put it.
Okay.
It sounds like they're more secure than ordinary shares. They do tend to offer a little bit more security.
Okay. But I mean, no investment is completely risk-free, right?
Right, but within that spectrum of risk,
Yeah.
preference shares have got a pretty interesting spot.
Right.
Not as volatile as ordinary shares,
Yeah.
but they could offer higher returns than bonds.
Okay, so they're like right in the middle.
Right in the middle.
That's a good balance.
Yeah, that's sweet spot for a lot of investors.
They're like the Goldilocks of the investment world.
Yeah, not too hot, not too cold, just...
Just right. Okay. So is that it, or are there different types of preference shares?
Oh, we got to talk about the different types.
Oh.
I know every time we peel back a layer, we find more.
There's always more.
But these are actually important
Yeah.
because they can really affect an investor's experience.
Okay, well, all right, lay it on me. What are the different types of preference shares?
All right, so first we have cumulative preference shares.
Okay.
Think of these like the friend that never forgets a favor.
Right.
If a company skips a dividend payment on a cumulative preference share,
Okay.
those payments, they don't just go away, they accumulate.
Okay.
They have to pay those in full before they pay any dividends to common shareholders.
Oh, so even if the company's not doing well, the cumulative people, they'll get paid eventually.
Eventually, they're not going to be left holding the bag.
They're going to get their due, okay?
They're going to get it.
Now, what about on the flip side? Are there non-cumulative shares?
There are non-cumulative preference shares.
Okay.
Those are a little more flexible.
Right.
If they miss a payment on these shares,
Yeah.
they don't
Okay.
have to make it up.
Oh, so a little bit more risk with those.
Yeah, more risk, but maybe higher potential reward.
Right, like investing in a startup.
Like investing in a startup, yeah.
Maybe you got to wait a little while, but maybe it'll pay off big.
Exactly. Okay, let's talk about redeemable preference shares.
Okay.
These are kind of like bonds in that they have like a maturity date.
Okay.
At some point, the company buys those shares back
Okay.
from investors at a set price.
So you get that steady income,
Uh-huh.
and then at the end, you get your money back.
You got it.
Okay.
Kind of a blend between bond and a stock.
It is. Okay, that's cool.
You might get some appreciation in price before that date, but you also have that security.
Right. You're
Yeah.
getting your money back.
You're going to get it back.
Okay. And then you mentioned before convertible preference shares.
Oh, yes, convertible.
Those sound interesting.
These give investors a little bit of an option.
Okay.
They can convert them into ordinary shares
Yeah,
at a
okay.
predetermined rate.
Oh, so you get the fixed income,
Uh-huh.
but you can hop over if things are going well.
If things are going well,
Yeah.
you can jump on that train.
You can join the party.
You can join the party. It's like having a ticket to the main event.
Yeah. You get to skip the line.
You skip the line, you're in.
Okay, I like that. Okay, so we've got cumulative and non-cumulative,
Yes.
redeemable, convertible.
Yes.
Are there any other types?
Just two more worth mentioning.
Okay.
Participating and stepped preference shares.
Okay.
Participating preference shares, those offer the potential for additional dividends
Oh, wow.
on top of the fixed dividend.
So you get even more.
You get even more if the company's profits exceed a certain level.
So like a bonus
It's like a bonus, yeah.
for sticking with them.
You got it. And finally, we have stepped preference shares.
Okay.
These have a dividend rate that goes up over time
Wow.
on a predetermined schedule.
So it's like a built-in raise
It is. It is like a built-in raise.
to keep up with inflation.
Exactly.
Okay, wow.
Yeah.
So much to know about preference shares.
It's a whole world.
It's like the secret menu for investors. It really is.
It's amazing.
So many options.
I think it's safe to say we've thoroughly explored stock exchanges
I think so.
from the beginning to all these tiny little details.
Yes, the history, the mechanics, the markets.
We've really seen how it all works.
We've really gotten into those inner workings.
Right. And this is a constantly evolving world, right?
Absolutely.
New challenges popping up,
All the time.
new opportunities too.
That's right.
But at least now we have a better
A
understanding
solid understanding.
of how it all works.
Yes.
So we can make informed decisions.
Exactly.
Knowledge is power.
It really is, especially when it comes to your money.
All right, so that wraps up our deep dive into the world of stock exchanges.
It does.
Thanks for joining us.
Thanks for having me.
And to all our listeners out there, stay curious, keep learning.
That's right.
Don't be afraid to ask questions.
There are so many resources available.
Right. It can seem complicated,
It can.
but, ultimately it's all about taking control.
Taking control of your financial future. Exactly. All right. That's it for us.
Until next time.
Happy investing.